Overseas aspects of corporation tax. UK resident companies. A company is UK resident if it is incorporated in the UK or controlled and managed from the UK on a day-to-day basis, usually where the board of directors meet. UK resident companies are taxed on worldwide income. Non-resident companies are only liable to UK corporation tax if trading in the UK through a permanent establishment, PE. Profits of the PE are taxable in the UK. Double taxation relief and tax planning. Include overseas income before any foreign tax within taxable total profit for UK tax. Double taxation relief methods. Exemption method, income only taxed in one country. Credit relief method, income taxed in both countries, but tax credit given in the UK. This is restricted to the lower of the foreign tax suffered and the UK tax on the overseas income. OECD model, unilateral relief, can be used if there is no double taxation treaty. Double taxation relief is calculated separately for each source of overseas income. Tax planning considerations. Avoid wasting double taxation relief when using qualifying charitable donations and losses. Set off qualified charitable donations against UK profit first, then allocate remaining qualified charitable donations and losses to the foreign source with the lowest rate of foreign tax. Expanding trade overseas. Option 1. Trade via a permanent establishment. Option 2. Set up a foreign subsidiary. Tax considerations. If loss-making and UK tax is high, use a permanent establishment, benefit from UK loss relief. If loss-making and overseas tax high, and if have sufficient cash flow, use a subsidiary, loss relief against subsidiary future profit. If profit-making, then double taxation relief applies. If you use a subsidiary, then controlled foreign company CFC rules may apply. You can elect to exempt all permanent establishments from UK corporation tax, but this will affect all current and future permanent establishments and is an irrevocable election. Takes effect from the accounting period after the election. It's not beneficial if you have a loss-making overseas branch. The overseas tax rates are high and UK tax charge after double taxation relief is minimal. Consider carefully as it affects all permanent establishments, is irrevocable, and reduces flexibility. Future overseas losses cannot be relieved against UK profits, and capital allowances will become unavailable. We will now look at permanent establishment and subsidiary in more detail. Permanent establishments. A permanent establishment is a fixed place of business through which an enterprise's business is wholly or partly carried on for more than 12 months. Examples: a branch, office, factory, workshop, mine, oil gas well, quarry, construction project. Does not include storage, stock maintenance, delivery, or a fixed place solely for purchasing goods, ancillary activity. Permanent establishment profits count as the parent's profit and are subject to UK corporation tax, with double taxation relief if taxed twice. This includes trading income arising directly to indirectly from the PE, income from property or rights used by or held by or for the PE, except any UK dividends received that were already taxed, chargeable gains from UK assets. Capital allowances are available. For non-resident company without UK PE, income from UK sources is not taxed under corporation tax. Certain types of UK source income, such as property rental income, that a non-resident company earns are subject to UK income tax instead. Capital gains are charged corporation tax if the asset is situated in the UK used for trade or PE purposes. Provisions exist to prevent avoiding gains by ceasing UK PE or exporting assets. Postponement of gains when converting PE to a non-UK resident subsidiary is possible under certain conditions. Overseas subsidiaries. Subsidiaries that are resident overseas pay foreign tax. Remit profit to the UK parent as dividends, not taxable for the UK parent. They count as a member for the large company payment on account threshold. But no loss relief against UK profits possible and no group relief. When dealing with losses and reliefs, overseas PE losses are typically netted off against the UK company's trading income. Usual trade loss relief available if an overall loss. Group relief rules apply to companies worldwide, but relief is only available between those within UK corporation tax scope, hence no loss relief for an overseas subsidiary. For UK permanent establishment of European Economic Area resident companies, loss relief is available if, and only if, all overseas alternatives are already used. For UK permanent establishment of non-European Economic Area companies, must use loss against overseas profit first. Transfer pricing prevents profit or loss shifting between companies under common control. Applies to transactions between two legal persons with common management or control. Adjustments are self-assessed. Advanced pricing agreements possible with HMRC. Thin capitalization rules apply to non-commercial rate loans between connected companies. SMEs are generally exempt unless involving non-qualifying territory. SME here is defined as less than 250 employees and either the turnover is less than 50 million euros or the balance sheet total is less or equal to 43 million euros. Controlled foreign companies, CFC. Applies when the company is resident outside the UK. Remitting profit, excluding gains, back to the UK. Taxed lower overseas. And 50% controlled by UK residents, or 40 to 55% ownership with UK shareholder owning 40% majority or more. CFC charge on apportioned profit to 25% UK company shareholders. Apportioned profit doesn't form part of taxable total profit, shown separately. Taxed at UK tax rate minus foreign tax paid. Exemptions. There is an initial exempt period of 12 months when a non-UK resident company is acquired by a UK resident. Tax exemption if local tax paid is more or equal to 75% of would-be UK tax. Excluded territories exemption. Low profit exemption if CFC profit is less than £500,000 and non-trading income is less than £50,000. Low profit margin exemption if CFC accounting profits is less than 10% of allowable expenditure. Non-resident companies and group relationships. Group relief and gains groups can be established through companies worldwide. Relief typically applies to UK resident companies and overseas companies with UK permanent establishments. Global group concept for gains allows no gain no loss transfers within worldwide groups. This applies to the transfer of whole or part of a trade, intra-group asset transfers, and business disposals as part of reconstruction. Other important points. A UK resident company cannot cause or allow a non-UK company that it controls, through ownership or voting rights, to issue new shares or loan stock unless certain conditions are met. If the transaction is within the same corporate group, between companies that are all part of the same larger parent company structure, it might be allowed. If the non-UK company issues shares or loan stock in exchange for full and fair market value, full consideration, this might also be permissible. The rule is in place to prevent UK companies from creating or altering the capital structure of foreign subsidiaries in a way that could be seen as tax avoidance or manipulating corporate control. UK resident company also cannot transfer shares or loan stock it holds in a non-UK company that it controls, unless it is done in a lawful manner, for example, within a group or with appropriate consideration. This rule is designed to prevent the shifting of assets or control in a way that might undermine UK tax rules or regulatory oversight. Transactions greater than £100 million must be reported to HMRC within 6 months unless in the ordinary course of trade.